And we are live. Welcome everybody. It's masterclass time. It's 1 o'clock on a Monday, just after lunch, the perfect time to follow this masterclass. It's about building the in-house bank from vision to value. Apparently a very popular topic. We have almost 150 people who registered for this topic. So that's amazing to see and hear. For those of you on the line, we do have a chat function. Please use it to ask questions to us during the session. We have time allocated at the end for questions, but if you see questions in the meantime, which is relevant to our discussions, we will post them to the panel members. For now, please use the chat function to say hi, where you're from. If you just want to share something, post it there. I already saw in the registrants we have a worldwide audience, a few people from Asia, definitely from Europe, and some early birds from the US as well. So glad you are here. Let me quickly introduce my panel. We have Paul Bach, Treasury Manager at Arriva Europe. Amazing expert on in-house banking. Very glad to have you here, Paul. Welcome.
Thank you.
And we have Matthias Varenkamp, Account Executive at Cobase, who will share the FinTech insights. And Cobase is the sponsor from this masterclass as well. My name is Patrick Koens. I'm the founder of Treasury Masterminds. I'm also a Treasury consultant. I know my fair share about in-house banking, so I will ask all the detailed questions to my amazing panel here. So before we dive in, let me wake you up and ask you a quick poll question. Feel free to answer it in the chat by just posting a number in there. Let me start with, does your company already run a cash pool or an in-house bank or both? If you run a cash pool, please put number 1. If you run an in-house bank, put number 2 in the chat. If you run both, put a number 3 in the chat. Curious to see what the answers will be. Matthias, you're talking to a lot of clients, obviously. What do you think the answer will be? More towards the cash pool versus the in-house bank?
What I see is that many have a cash pool running, but then not on all banks. So typically they have a cash pool running on the main bank. However, there is still a lot of opportunity for those banks that operate outside of the cash pool. On the in-house banking aspect, I think there are less that operate in in-house bank.
There's definitely no number 2s until now in the chat. So nobody wants an in-house bank without cash pooling, which makes sense. I get that, but I have to ask.
I would have said, Patrick, it's an interesting question because as soon as you have set up a cash pool, you are already running a basic in-house bank. So it's a matter of what is the definition? Eh?
Yes, no, definitely, and that's why we asked this question as a starter, which is a nice starting point here. I do see a few. I think it's about a 50-50 here on cash pool, just basic cash pooling or both, and the full setup running. Like you say, if I have cash pooling, I also need in-house banking. Good, great. Let's start with the basics. It's also a masterclass, so we're also about teaching. Paul, let's start with what are the main drivers for centralizing cash? Is it visibility, control, efficiency? What are the main reasons you are seeing?
It's actually, I think, a very interesting question because all those topics should be a priority for Treasury in general. To me, this touches the question that I always pose. From a Treasury perspective, cash doesn't belong to the local subsidiaries. Cash belongs to the company. And Treasury in general has the mandate to manage the cash from the company. So whether it's visibility, control, or just efficiency, I think setting up a cash pool plus an in-house bank is just a matter for Treasury to take control and manage the cash in the most efficient way for the company. A very standard sample is if you have a legal entity that has a cash surplus and puts that in a deposit with an external bank, you can also have on the other side a subsidiary that's in a need for a bank, going to an external bank for getting a lending. If you bring that together in treasury, you can do this. You can do this much more efficient. So that's a very standard and basic example. To answer your final question, yeah, visibility and control plus efficiency, that should be just core to a treasury team.
Yes, no, definitely. And maybe especially now where interest rates are a bit higher now. In Europe, maybe only 2%. But the US, we are at 3.5%, 4%. We're not at 0% anymore. It matters where your cash is and definitely how much interest you're getting on your cash as well. Great.
Maybe to add on to that also, because I think that's also a good example that Paul mentions, because I think it always starts with visibility. So I think also what I tried to emphasize in what I first told about the cash pool is that many companies operate a cash pool with their main bank. However, they might not even know which money resides with a local bank on a local level, with a local subsidiary. And very typical, you see that they get an Excel spreadsheet, maybe once a month, or maybe in the best case once a week, telling how much cash is there. And indeed, typically a lot of subsidiaries want to hang on to their own cash. So it all starts with that visibility, and without visibility, you're nothing.
Yes.
To add to that, Matthias, the company I work for today has one golden rule. If you have a bank account, you have to have it reported empty 940s to the treasury. If not, we will close your bank account. It's a very strict rule.
It's a very strict rule indeed. Yeah. And I think many treasurers would envy you on this rule.
Definitely. Big tip of the Inners Bank, just force them to report.
If not, you have to explain to the corporate CFO why you're not having empty 940s delivered. Are you hiding something?
Yes, turn it around. Indeed, the liability with them instead of the treasurer chasing the companies for setups. And you have a fair point there. Cash pooling doesn't have to be with one bank. Yeah? You can also do cash pooling manually, which is a bit more hassle. You need tech, which leads to my next question, Matthias. From a technology standpoint, what trends are you seeing? Easier to build? Is it easier to build an Inners Bank now because of better tech, because of easier access to liquidity? Curious to hear what you're seeing.
Yeah, so I think it's also a topic we have been focusing on the last several years. I think once you operate, for instance, treasury management system where you have the visibility on all the accounts and you are able to perform payments also on all those different accounts, indeed you can manually fund and sweep the accounts. However, in Cobase, for instance, because we set up the payment production, we have also set up a funding and sweeping engine, essentially, where you can automatically fund and sweep target balance certain accounts. And I think in recent years, because of interest rate spikes, it has also become more interesting to move funds to an interest-bearing account. Not only looking where cash is short or there is too much cash, but it can also benefit the company as a whole to move it into an interest-bearing account as such. So the return on investment on that can be quite big already from that standpoint. And then now we're parking purely on the cash pooling side of things. Yeah.
Yes. No, definitely. I had one client who had local bank accounts and there was only 500,000 on it. But they had maybe 40, 50 of those accounts with only 500,000 on it. So adding that led to almost 20 million. If we could pool that, obviously it's hard to manually pool that to zero. That might not be very efficient from a cash management perspective. But with the help of tech, if that's possible to automate that, target balances, automations, connectivity, I could centralize maybe 15, 20 million extra. Could use that for internal funding, like Paul said, or invest it at the capital markets 2 to 4%. There's a lot of money saved there. It's all about the money, and it definitely created a bit of discussion there in the chat.
And then indeed, I think you move to the next step, and that is really the in-house bank, because you need to administer those intercompany positions. You need to calculate interest. You need to have agreements, etc., on them. And I think also for many treasury teams are not big teams. They are led by a small group of people that are very hands-on, that maybe have also additional things in their portfolio, as maybe even insurances, maybe some risk and compliance, etc. And then making sure that everything is administered in the right way and maybe automated even as much as possible. That is, of course, the next step. So I think many people want to cash pool, but they don't have the tools or the administrative tools to make sure that they are compliant to all the nitty-gritty stuff that comes along with cash pooling.
Yes, fair point. Nice bridge. Let's dive into examples. We've Paul here. Paul, you've built many in-house banks before in your career. Let's start with, can you walk us through how do you build an in-house bank? Where do I start? Where do I end? And in between?
To build a bit on what Matthias just said, and also to what I said already all the way in the beginning, if you have a cash pool set up, you have already a basic in-house bank. My experience in this case is actually prior to setting up a cash pool, you have to make sure that your legal, but even more important, your tax framework is properly set up. Once you do cash pooling and you have your basic in-house bank concept, the treasury side to a large extent is a technical side, but particularly the tax framework is the most, I would say, cumbersome side of it, because like you said, Matthias, it's not only setting up the cash pool, but once you set up a cash pool, you are sweeping money from the central, from the local subsidiaries into the treasury, or vice versa if it's a funding transfer. That is intercompany, but it needs to be priced against arm's length values. And this is where the tax discussion, the tax framework comes into play. You need to make sure that tax is 100% aligned with what kind of pricing you use for your intercompany lending and for your intercompany depositing, because it works both sides. It's depositing and lending. After this framework, as a treasury, you need to make sure that you make a decision whether you want to do notional cash pooling or physical cash pooling. Notional cash pooling has a little bit less of a tax impact because funds are not actually moving. But there's this other item that you have to look into, and that is with notional pooling, you're actually pledging all your balances to the bank. And not many people realize what it means if you're pledging all your funds on a daily basis to the bank. Effectively, it means if one of your subsidiaries in the cash pool goes bankrupt, the bank is entitled to take to compensate funds from any other participating bank account. That's effectively what it means. And a lot of people do not really realize this. So this is the notional pooling. If you go into physical pooling, that makes things, in my view, a little bit more clear, because you are effectively transferring the funds from the legal entity into the treasury or vice versa. You know for sure who owns the funds then at that point. But to add to your comments, Matthias, it's not only the cash pooling itself. You have to administer for all the movements, because those movements, I compare those movements to the standard process with a normal current account with an external bank, where you move funds into a bank account and you move funds back from the account. Effectively, you are lending money to the bank, or you are lending money from the bank if you're overdrawing your account. That mechanism is exactly the same what you're doing with a cash pool. This is what we have done, or what I have been doing in other companies as well, is you need to have an agreement with each of your individual legal entities that you are setting up a cash pool, and what are the consequences of a cash pool. The balances, who owns the funds, if you are transferring through a cash pool funds into central treasury now has a liability to the local entity, and vice versa. We also look into the funds that are building up into the cash pool. Similar to an external bank, you just don't build up cash in a current account. If you have a substantial amount of cash sitting in your current account, you look for depositing at a higher interest rate. Same with an in-house bank. If you see an in-house bank account building up cash, you start talking to your local subsidiary. Can we take the cash out? Can we give you a higher interest rate, a deposit interest rate? And obviously, as a treasury, you manage your excess cash externally. This again goes back to your tax framework, because if you have cash sitting in your in-house bank account, this needs to be remunerated with a arm's length interest rate. If you take cash out of the excess cash out of a in-house bank account and you convert that into an internal deposit, you also need to apply arm's length interest rate. And obviously vice versa on the lending side, this is exactly the same story. So going back to where I started, I think you need to start with setting up particularly your tax framework. If your tax framework is correct and the interest rates that you're going to apply to debit positions and credit positions in your in-house bank and your deposit interest, but also your intercompany lending interest, if you have that set right in your tax framework, I think you are safe. Why is this important? From a company perspective, to be honest, most CFOs don't care because it's all intercompany. But each individual legal entity talks to the local tax authorities, and they don't give a care that it's a company, an intercompany structure. They look at the balance sheet of a local individual legal entity. And if you, as an example, if you have a legal entity that keeps your cash in the current account from the cash pool, and they're building up cash, at a point in time, the local tax authorities will say, nobody would leave so much cash in your current account. Usually you should put that on a deposit and make some extra money. You haven't done that, but we don't care. We make an estimate and we'll charge you extra tax. And vice versa also. I've seen companies where the interest rate setting was, I would say, bad, because it would make more sense to lend from the cash pool rather than from a long-term intercompany lending. And I've seen companies where people or legal entities kept hundreds of millions cash in the cash pool, which is just not right. You wouldn't do that. You don't lend money from the cash pool. Similar as you with an external bank, you're not lending money from your external bank by just overdrawing your current account. You go to your bank and start negotiating a lending facility. So going back, the framework, the legal and the tax framework is for me the first starting point. When I say legal, all the supporting documentations, I think, need to be set up / reviewed by legal. But tax is the driving part in this case. From a treasury perspective, you need to make up your mind what kind of tools you would like to use. And I mentioned predominantly notional pooling or physical cash pooling. That drives your solution on how you're going to use the cash pool structure. You mentioned with a number of companies that have one single bank, what they do cash pooling with. The current company I work for, we do multi-bank cash pooling in 10 countries with more than 20 different banks. The only solutions where you can handle this is if you have solutions like Cobase or any other treasury management system that offer cash pool services. And then you go into the mechanics of the cash pooling itself. Do you cash pool end of day? And what is your basis to calculate your balance end of day? Is that through the treasury management system? Or like we do in the company I work for, we base ourselves on MT 940s. But that's always at the end of the day, and we receive that information overnight. So we always overnight late with funding. If that is the case, you need special credit facilities with legal entities to support them if you want to do zero balancing. So what I'm trying to say is you first start with your legal/tax framework. And next, as treasury, you try to determine what solution do we want to have as treasury, whether it's notional pooling or physical pooling. And next, what is your landscape? Are you working with one global bank on operational level, or do you have a multi-bank solution? That determines on what technique you are using and what tools you need.
Yes.
It's a lot of things to reflect and to think of.
Maybe to hop onto that. So really, what Paul has explained extensively really resonates with me, because quite often I also hear customers coming to us telling that they want to start with cash pooling, start with in-house banking, but then they did not think already about this legal and tax framework. No. Or sometimes they come up with examples and making it really complex. So I think it's also about keeping it simple, keeping it manageable. How do you apply it? And I think indeed what is also a big important step is the admin tasks around the in-house bank. So a treasury management system can help you set rules, can help you set who's the admin of this in-house bank. Where do you administer all the legal paperwork also associated with it? Do you have maybe a direct feed with, for instance, we have a direct feed with Refinitiv, the London Stock Exchange Group, where you can get different interest rates for different countries, for different entities. Because I think I saw it also in the chat, it can differentiate per country, it can differentiate per entity. So there also, I think tech can help you very much. And then I think one thing that I was aiming on already for a long time, and I was happy that Paul mentioned it indeed, and TMS that can help you with multi-bank cash pooling. Because also many companies might not even be able to start a cash pool at the bank because maybe they are not allowed because of credit facilities. Maybe it is very expensive to do cash pooling with a bank. Maybe they only have limited accounts with a bank. And then a tool such as Cobase, a treasury management system, which can help you with this multi-bank cash pooling, can step into that gap where traditional banks leave the space for us to operate in and help you operate a multi-bank cash pool. So I think that very much resonates with what I see in practice.
To add to this, Matthias, my experience when it comes to cost, my experience is when you do physical cash pooling, most banks will offer that, and the fees for that are relatively mild, let's call it that way. Notional pooling, given the Basel III agreements, both notional pooling can be very expensive for a bank to offer. And I recall banks in past that said, if we would offer you a notional pooling, it'll cost us some 2 million on an annual basis, which we will charge through to you. And apart from that, we will start charging you for the use of the cash pool. So although notional pooling has its benefits, there's also a downside to that. I already talked on one downside, which is the pledging of the funds. And the second one is the cost for a bank. And this can be a showstopper.
Yes, I've seen it happen. And it's a bit chicken egg thing, Paul, Matthias, because you have pooling in place and a notional pool, I already have the cash from a central perspective. I can use the cash, so it doesn't matter if it's the subs cash or my cash. I'm already using it. I've seen situations where HQ has no money at all, but because of cash pooling holds all the money. So HQ's balance position is maybe minus 300 million. but they hold 350 million in the cash pool, all the substance money. And then you create a situation also for the bank where you have a lot of offset positions, minus 300 plus 350 million. The bank looks at the negative position. I think that's where they have to hold risk-weighted assets against, and that's what costs the money. I've seen notional pool solutions where the bank restricts the amount of debit position, which is a very weird situation to be in, because if I dividend out money, minus 300 plus 350 is plus 50 net. I could dividend out 300 million and have 0 and 50. For me, it's the same. It didn't change a thing. For the bank, it changed the world, and you probably get a discount or rules. So what I'm hearing from you two is, from a treasury perspective, in-house banking is very easy. It's just transferring money between accounts. I can do that manually, can do that with a bank, or I can use tech. But to do it right, you need an amazing legal framework, and you need to, of course, talk to tax to make sure that you are arm's length and compliant on a tax perspective. And then I hear Matthias saying to do that in a more efficient way, it's really good or almost needed to have tools in place to help you do these actual transfers and admin these positions. Because if you do them manually and you don't care anymore, I think your accounting department will chase you, will find you, and will kill you for it, because they have no idea how to book it or create the positions. TMS can help.
To add a little comment to this, Patrick, I've been working for a company in past where the tax department actually asked me to change from a notional pooling into a physical pooling. And their rationale was, with the notional pooling, we are not 100% sure who owns the cash. Because if you pledge your funds, are you still owning the cash or not?
Yes, fair point. Difficult discussion, because there's no answer to it.
No, exactly.
It's a cross guarantee between the matrix. Everybody guarantees each other.
And this is why for that company, the tax department asked me, although there are some downfalls for physical pooling, the tax department asked me to switch over to physical pooling.
Yes. Matthias, does it matter for you?
Yeah, I think also from a technology perspective, a physical cash pool is more straightforward, because you have the debit and the credit bookings that you can mirror in your in-house bank administration, where, of course, with a notional cash pool, there are no cash movements, however the cash is being used. So also from a technology and automation perspective, it's way easier to reconcile against the different transactions that take place on a physical cash pool than on a notional cash pool. So yeah, but every company has their own needs, and it doesn't necessarily mean that one is better than the other. It's really about what fits your company, what fits your use case. And that is most important, I think, in this aspect.
Yeah. And if you decide for physical pooling, usually I advise companies to first try to understand how a commercial bank works in essence, because you're replicating the mechanism exactly in your own in-house bank. And if you understand how an external bank works, you also understand what are the things that you have to look after in your own internal bank. You mentioned documentation. You mentioned administration for the daily movements. A bank does the same. So you really need to think of how does a commercial bank works in the essence, and replicate that mechanism, including all the documentation, including all the administration.
Yeah, fair point. It's called an in-house bank for a reason.
Yes,
you
exactly.
are replicating a bank, so you have to act like a bank. And I think that didn't happen in the past before. Mistakes have been made. Banks have been written off cases where it went wrong, so they are more prudent as well. But there's also documentation now, OECD rules. I don't necessarily want to go into the legal full set of documentation, not necessarily
I get that, but you also have to take into account that some 20 years ago, tax authorities were not really up to speed what physical cash pooling means. tax authorities have learned their lessons, and they also exactly know what this means, and therefore are more scrutinizing if you have a cash pool structure set up. So you better be prepared for that.
Definitely. But Matthias, you've seen many setups in your tool, of course. What makes or breaks a setup? What works better? What works? What's more difficult? You already mentioned it's easier for a physical pool to admin versus notional. But tips and tricks from your side.
Yeah. So two of them I think I mentioned already. So one of them is making it not going to your tax and legal department to make sure that everything is in place beforehand. The other one is indeed adding a layer of complexity, maybe also working with a fine system. I've seen it also coming across that you want to fine certain entities on certain aspects when, for instance, loans are not being paid back on time. I think that also adds another layer of complexity. Third, rule of thumb is maybe start small. So if you're not operating already a cash pool or in-house bank structure, start with the one very close to home. Start maybe with your main bank and then start expanding it to other entities. Get lesson learned into it. Maybe even I'm not a big fan always of external consultants, but building an in-house bank and not having the knowledge in-house, ask an external consultant to help you set the framework, to build it out. They've done it many times with many others before. They know what comes along. So I think this is one of the great examples where you can benefit from a fresh perspective and external consultants.
Yeah, that's amazing advice. If you start with 20 banks in 30 currencies in 55 countries, it's going to be complex, and one connection is going to break. You have 100 transfers on the day. Please find out which one. If you start small, amazing advice. Start small with 2 or 3 countries, one currency. Test yourself. Can the software do it? Most probably. But then the proof of the pudding comes. Did accounting also get it? Can they admin it? At month end, is the interest rate correctly applied? Is it calculated? How is it being paid? Is it amortized or not, etc.? If that works, you add more countries. If that works, you add more currencies and therefore complexities. The choices to be made. And of course, I'm a bit biased. I've done a fair share of in-house bank implementations. It helps to have a consultant. But also we have connections to the legal frameworks as well. We can definitely help with that. You don't need a big law firm with 500 pages of documentation. There is fairly standard documentation out there where we as a consultant can help out with, and specialized consultants as well.
And maybe also, I see a bit of criticism in the chat from Alexandra, and I totally agree with her. We're now very much focused on the cash pooling side of an in-house bank, but of course, most likely you maybe have also long-running intercompany loans. Start with administering those in the intercompany loan administration. Maybe you can benefit from intercompany invoice netting. Try to net as much as intercompany invoices and reduce the amount of physical payments that you're performing. As such, maybe you can benefit via trading FX via the holding instead of every subsidiary trading on its own. So indeed, there are much more benefits also to an in-house bank than pure on the cash pooling side of things. And you should really look what benefits your company the most short term, and maybe also straight away the return on investment, because indeed from FX management or maybe from a cash pooling side, you can get a return on investment already quite quick.
Yes,
I want to add two comments to that. From netting perspective, you can also use your in-house bank to settle payments cashless. So rather than doing external netting, if you have a lot of intercompany payments, externally net that into one amount and settle once a month, for example, you can also change your in-house bank in such a way that the payments are being settled cashless in the in-house bank. And that makes it really efficient. When it comes to FX, most companies I work for we actually prohibit the local subsidiaries to go out and do their own FX. If there is FX, you have to come to treasury. But then obviously you have a different discussion. You first have to understand what is an FX exposure. And not everybody in subsidiaries have 100% full understanding what is an FX exposure. I always say that treasury needs to dictate what an exposure is. And secondly, treasury has the best knowledge in-house to manage FX exposures. So you are prohibited locally to do any of your own FX. You have to do that through treasury. That's the way I've seen that in many companies, this approach.
Yeah, in theory, and this is very much theory, you need one bank account per currency worldwide for the company. Because if you are that good, your in-house bank can do that. You have receivables on behalf, you have payments on behalf, you have PICs on behalf. All the intercompany invoices are booked on the in-house bank positions. This is, of course, the dot on the horizon, which nobody achieves. Very much impossible and very complex to achieve. But with starting small for Matthias, this could be your end goal.
You need to have your foundation properly set up before you can build the nice things on top of that.
Yeah. I think it's interesting indeed, because also I once read an article about it. I think Maersk was running a project trying to run all the SEPA payments via €1 bank account. But I think, as always, in theory it could work, but in practice there are always these bits and pieces that overcomplicate it. But of course, there also is still a lot of changes taking place that could benefit, I think, also this long term in the Euro SEPA zone as well.
Yes, you still have the odd Italian tax payment or Spanish tax payment where you need to have a local bank account.
Yeah.
That's a different discussion.
Definitely. I did see some audience questions on API, instant payments, bank connectivity. Maybe let me add digital currencies, stable coins to it. Matthias, would that change the way we do in-house banks?
So I think, of course, APIs are the buzzword. You can achieve the same, of course, via traditional host-to-host channel. But having insight on the liquidity on your accounts during the day still should enable you also to act upon it. Because, of course, you can sweep from an account during the day, but if your accounts payable is preparing a payment that needs to go out and the account has just been swept, you need to sweep it back again. What I see, however, is a big benefit for the instant payments, because essentially it will enable you to perform payments even outside of times. So at the end of the day, you sweep an account, you put it into an overnight deposit, and in the morning you sweep back the money to the accounts again for daily liquidity. So I think there could be a big benefit to there, because now you really need to adhere to the cutoff times, and maybe doing even an interbank transfer. It might end up not reaching the bank on time. So there are still some downsides to that as such. And I think the movement towards blockchain and tokenization, I think that really gives the benefit of the international transfers, where you can see now still that transfers can take many days to reach the counterparty or reach one of your accounts, where this via blockchain, of course, could be within, depending on the blockchain, within 30 minutes, an hour. Yes. Essentially everything quicker than 3 to 4 days already is a big benefit for, I think, many corporates.
Definitely, that's what we want. We don't want to wait for our money for 2 days. A payment from Australia to the Netherlands taking 2 days. Very hard to cash pool. Even if it's in the same bank, it's sometimes difficult. If I can do that within hours, you have more liquidity, Paul. You can do more end of day if there's even an end of day left. I don't necessarily want to work till 5 to 12 at night, Matthias, so this 24/7, I'm not sure. I think we have to agree in an internal cutoff time, because I'm working till 6.
But in that case, you need Cobase, because you can set the rules automatically.
Good answer. Good answer. No, but that's where we're going at 24/7, everything faster, more automation, because that automation is going to help us not do cash pooling manually anymore, or based on old information. I see a question for you there in the chat, Paul. In-house bank, do we create a new legal entity, or do we take the HQ entity, where Treasury is, as the entity? A bit of discussion there.
Well, I always have considered the Treasury as, if Treasury isn't a separate legal entity, I always have considered the legal entity as the in-house bank. So from that point of view, I don't see a need for setting up, on top of that, an extra legal entity. I've had the discussions with companies whether the holding should incorporate the Treasury / the in-house bank. The argument against that is that if you take a holding, it has its own function. The in-house bank is another function. You're commingling functions in a legal entity. If you separate your in-house bank, and again, in my view, the Treasury usually is the in-house bank. If you separate that and have the Treasury / in-house bank a separate legal entity, you make it very clear on what the balances are and what the assets and liabilities are. Again, from accounting perspective, you can commingle that, but it makes it less clear. If you put it in a separate legal entity, it makes it very clear what are the liabilities and what are the assets. And to understand whether the cash pool / the in-house bank is profitable or losing money, you can separate in a legal entity, you can separate the short-term money against the long-term lending and deposits. And so far, my experience is that cash pools, certainly if you are in a cash-rich company, a cash pool is a loss-making functionality for an in-house bank, but they usually make up when they have additional intercompany lending, which has a higher interest rate to be charged. If you do that in a holding where you mix functionalities together with other functionalities, it makes it more difficult to understand is your in-house bank a profitable business or not.
That's a very good point, because then in a separate entity, it makes it more auditable.
Yes.
That's what you're saying. Then you can really see the P&L of the in-house bank. You can show your auditors, this was my margin on lending, this is my margin on borrowing. Usually I make money. Of course, it depends on the positions, but very much auditable. I've worked for these companies and these lending company, internal lending, in-house banks of corporates. It really works like a charm. Explaining the auditor who struggles with treasury knowledge to understand. Yeah.
And working for a company that has a mixed functionality on the holding, in-house bank on the holding. If the holding has a significant external lending, you pay a lot of interest to the external lending. So how do you make sure that if you put your in-house bank on a mixed legal entity, how do you explain that your in-house bank is still profitable? I mean, as Treasury, you're not supposed to make profit, but still you have to show the benefit to the company.
Good value, yes.
Good value. But if the other functionalities are loss-making, it looks like the whole Treasury structure is not beneficial to the company.
Yep, no, definitely. We are out of time. I just want to ask one final question to both of you. Short answers, please. For those in the audience who are just starting, they got inspired now, I want an in-house bank. Where should they start? Paul, you go first.
I already mentioned before, tax and the legal framework for me is key. But for me, there are two other topics that we haven't discussed. And that is, first of all, make sure that your subsidiaries, that you take them along in your story. You have to explain to them what Treasury is going to do and what is the impact on them. If you don't do that, and I've had the experience a couple of times before, if you don't do that, the subsidiaries are going to work against you, and you don't want that. You want their cooperation. And secondly, don't underestimate the effort that you have to go through not only in time but also in FTEs. To the extreme, I once had to set up a full new bank plus a new in-house bank in 18 months' time. I was talking about 200 legal entities in 50 countries. I had to run a project team of approximately 100 people to manage that. It's not 100% day-to-day 100 people, but so many people were involved in such a process. Don't underestimate the workload and the effort to set up an in-house bank properly.
Thanks, Paul. Matthias, final words.
I will keep it short. Start with having full cash visibility group-wide. I think that is for many treasurers out there still a topic, and many of them still haven't achieved it. So start with that. Start with the ability to maybe manually also take control of funds, to be able to move those funds by hand, and then start looking into automating, administering, etc. But that is the very first start, because sometimes treasurers are already thinking 2 years ahead, but that's the absolute basis. Yeah,
no, definitely. And quickly on the business case, is there often a business case for an in-house bank?
I think yes. I think in many fast-growing companies, it has a business case. Yeah.
No, definitely agree. Thanks, Matthias. Thanks, Paul. We're out of time. We're already above time. Thanks also, audience. I liked what happened in the chat where people posted questions, very good questions, by the way, and we weren't even able to do half of them. There were so many questions. So my advice to the audience, if you still want to ask this question, connect with Paul on LinkedIn or Matthias on LinkedIn. They're very happy to answer a few questions. I think we should do a follow-up on this, a blog or an explainer, anything, because this topic is very popular. But also thank you, audience, for posting your comments, not only questions, and making it a lively discussion. This made it really an insightful masterclass. We're at the end for today. Thanks for joining. Keep a lookout for Treasury Masterminds and our content. And our next webinars in 2 weeks on FX and de-dollarization with Ebury. But that's enough marketing for today. Thanks, Paul. Thanks, Matthias. Thanks, audience, and enjoy the rest of your day.
Thanks, Patrick. You too. Cheers.